Is covered straddle good for beginners? Have you ever wondered if a covered straddle is a good choice for someone just starting in options trading? Let's break it down together. A covered straddle is an options trading strategy where an investor owns the underlying stock and sells both a call option and a put option at the same strike price and expiration date. This strategy aims to generate income from the premiums collected from selling these options while holding the stock. Now, if the stock price stays close to the strike price, the covered straddle can provide steady premium income. For instance, if you own 100 shares of a stock priced at $100 and sell a call and a put both at the $100 strike price, you collect premiums upfront. If the stock price remains around $100 until expiration, you keep the premiums as profit. However, there are some significant risks and complexities involved that can make this strategy less suitable for beginners. First, the downside risk is substantial. If the stock price falls sharply below the strike price, the short put option may be exercised. This means you could be forced to buy more shares at the strike price, leading to large losses. At the same time, the value of the stock you own may decrease, increasing your total loss. Additionally, the profit potential is limited. The maximum gain is capped at the premiums collected plus any gains up to the strike price. If the stock price rises above the strike price, the call option is exercised, and you may have to sell your stock at that price, limiting your upside. Another factor to consider is that this strategy requires active management. Since you are dealing with both a long stock position and short options, you need to monitor the situation closely, especially if the stock price moves significantly. Furthermore, the capital and margin requirements can be challenging for beginners. Owning the stock and selling both call and put options requires substantial capital, which may not be feasible for those just starting out. Lastly, the covered straddle is more complex than simpler strategies like covered calls. A covered call involves owning stock and selling only a call option, which is easier to understand and manage. In practical terms, the covered straddle works best for investors who have a bullish to neutral outlook on the stock and are comfortable with the possibility of owning more shares or having their stock called away. It is most effective in stable or slightly bullish markets where the stock price is expected to stay near the strike price. For beginners, it is generally recommended to start with simpler strategies like covered calls. These involve less risk and are easier to grasp. The covered straddle's combination of owning stock and selling both calls and puts introduces risks and management challenges that may overwhelm new traders. While a covered straddle can be an effective income strategy in the right market conditions, it is not typically considered ideal for beginners due to the higher risk profile and complexity involved. Focusing on mastering more straightforward strategies first will help you build a solid foundation in options trading.